We're jumping straight into Palantir today. Everyone is watching the price action, but the real story is the explosion in U.S. commercial adoption. The stock has doubled, maybe even tripled, depending on your entry point over the last year. We're talking up somewhere between 140 to 160%. But the fundamentals underneath the hood are actually moving faster than the ticker itself.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of why this company is suddenly, sucking all the oxygen out of the room on Wall Street, do us a quick favor, hit that subscribe button and hit the like. It really helps us keep the lights on and keeps you ahead of the curve. Okay, so let's unpack this beast.
It really has transformed into a different animal. For the longest time, Palantir was, well, it was pigeonholed. They were the secretive government contractor, the spy tech guys.
Right, the CIA's software company.
Exactly. Investors looked at them and saw a consulting firm for the Pentagon. Reliable, sure, but not exactly a scalable software giant. But if you look at the data coming out of Q3 2025, that whole narrative is dead. We are seeing a complete paradigm shift.
That is the pivot everyone was waiting for, and it feels like it finally snapped into place. I want to look at the headline numbers from that recent Q3 report, but through that specific lens of the pivot. Total revenue hit $1.8 billion. That's up 63% year over year.
Which is already impressive.
It is. But here is the aha moment for me, and I want to make sure everyone catches this. The U.S. commercial revenue grew 121% year over year.
121%. That is the statistic that matters. Everything else is basically noise. To put that into perspective, for years, the bear case was they can't sell to the private sector, the software is too weird, too complex, too expensive for a regular Fortune 500 company.
Yeah, that was the whole story.
And seeing that kind of growth in the U.S. commercial sector proves that private companies are now buying the software faster than the government is.
It effectively decouples them from being just a government stock. And it's not just that they're buying it, they're devouring it. We're seeing customer counts jump, deal sizes expand. But what I love about this current setup, and this is where I think the bulls really have a point, is the efficiency. Usually when you see a tech company growing revenue at 63%, you expect the balance sheet to look like a crime scene.
Right, the classic Silicon Valley growth at all costs model. You burn $1 to make 80 cents, hoping that one day you'll have a monopoly.
Exactly. You're lighting the furniture on fire to keep the house warm. But Palantir is flipping that script entirely. This brings us to the rule of 40. Walk us through this, because usually this is a target companies really struggle to hit.
So in software investing, the rule of 40 is sort of the gold standard. It suggests that a healthy company's revenue growth rate plus its profit margin should equal 40%. If you grow 20% and have 20% margins, you score a 40. You're elite. If you're above 40, you're a unicorn.
Okay, simple enough. And where is Palantir sitting right now?
Well, they aren't just passing the rule of 40. They are effectively breaking the calculator. If you take their 63% revenue growth and add their 51% adjusted operating margin, you get a score of 114%.
114. That doesn't sound real. Usually in SaaS, if you're hitting 40, you're popping champagne.
It is absurd. Analysts are having to invent new terms for it, calling it a rule of 80 profile, because rule of 40 doesn't do it justice anymore. It implies that for every dollar of revenue they bring in, they are keeping a massive chunk of it as profit while still growing at hyperspeed. It completely defies the logic that you have to choose between growth and profitability.
So how exactly are they pulling this off? Because usually, to grow revenue by 63%, you have to hire 1,000 salespeople, buy Super Bowl ads, and just burn through your capital.
Well, they're relying on extreme product efficiency. I found a really fascinating tidbit in the notes about how they're achieving this. They're actually using their own software, the AIP or artificial intelligence platform, on themselves.
The ultimate dog fooding.
Precisely. In the first half of 2025 alone, they used their own platform to identify efficiencies and saved over $30 million internally. But here's the kicker for the investor. That efficiency bleeds into their sales cycle. They aren't spending months wine and dining CEOs. They run these things called boot camps. They install the software, show value in like 48 hours, and close the deal. That keeps the margins fat and the growth fast.
So we have explosive growth, massive margins, and a sales cycle that is incredibly lean. But let's play devil's advocate for a second. Whenever I see a tech company explode like this, my first question is, Why can't a competitor just copy it? Why can't Microsoft or Google or even a Snowflake just build a Palantir Lite?
This brings us to the moat. And honestly, moat is a word that gets thrown around way too much, but with Palantir, it's legit. The moat isn't just technology, it's integration. Palantir isn't just an app you install, it's an operating system. When a company deploys Palantir, they are building something called an ontology.
Okay, ontology. That's a $10 word. I feel like we need to break that down because I hear it on the earnings calls and I see eyes glaze over. What does that actually look like for a business?
The word ontology scares people, but think of it this way. Most companies have their data in silos. The sales data is in one box, the factory data in another, and the shipping data in a third. They don't talk to each other. It's like having a body where the eyes don't talk to the hands.
Right, the classic Excel spreadsheet hell where you're trying to merge three different reports.
Exactly. Palantir's ontology breaks those walls down. It creates a digital map, a nervous system, where the factory object knows exactly what the sales object is doing. So if a machine breaks in the factory, the ontology automatically tells the sales team to stop taking orders for that specific product.
Okay, that makes sense. It connects the brain to the limbs.
And that is the moat. Once a company spends 6 months building that map, connecting all those nerves and muscles, they aren't going to rip it out just because a competitor is 5% cheaper. It becomes the central nervous system of the entire organization. You just don't replace your nervous system on a whim.
That explains why the total contract value, or TCV, is skyrocketing. I saw it hit $2.76 billion, up 151%. That tells me these companies aren't just testing the waters, they're signing massive long-term commitments.
Exactly. That stickiness is why the market is assigning such a premium to the stock right now. Investors know that once Palantir is in, they rarely get kicked out.
Speaking of the market, let's talk sentiment for a minute. Because the whales are circling, we're seeing institutional investors accumulating shares, and the price targets are moving up to match the hype.
We are. Truist recently put a target of $223 on the stock, and the street high, the most optimistic analyst out there, is looking at $255. These act as psychological magnets. When investors see those numbers, it validates the momentum. It tells them that the smart money thinks there is still runway here despite the rally we've already seen.
It feels like the perfect storm for the bulls. But, and there is always a but on the Easy Money Show, we have to look at the flip side. We cannot ignore the valuation.
No, we absolutely can't. And this is where the air gets thin. If you look at the traditional valuation metrics, Palantir's is arguably one of the most expensive stocks on the market.
It is nosebleed territory. I mean, honestly, looking at these multiples makes my stomach turn a little bit.
Yeah. It's vertigo-inducing, sure. But we have to be careful not to just look at the PE ratio in a vacuum. Yes, it's trading at 200, maybe 400 times earnings, depending on how you slice it. But the bulls would argue that PE is the wrong metric for a company scaling this fast.
Okay, play the lawyer for the defense then. If PE is irrelevant because they're reinvesting or growing so fast, what are we looking at? Price to sales.
Even there, it's tough. It's hovering near 100 times sales. For context, Microsoft, the absolute king of software, trades at maybe 12 or 13 times sales. So you're paying 10 times the premium of Microsoft for Palantir.
Whoa. That implies the market thinks Palantir is going to grow 10 times faster than Microsoft for the next decade. That is a massive bet.
It is. And that's the danger. At 100 times sales, the stock is priced for perfection. It can't just be good. You have to be spectacular. Every single quarter. Any slip up, any slowdown in that growth rate, and you could see a massive correction. We call it multiple compression, where the stock price drops simply because investors aren't willing to pay such a high premium anymore, even if the company is still making money.
And it seems like some people inside the building are aware of that valuation too. We are seeing some insiders take chips off the table. I saw a headline about the chief revenue officer, Ryan Taylor.
Yes, in early January 2026, he sold about $2.1 million worth of stock. Now, we have to be fair here. Context is key. This was a Rule 10b5-1 plan.
Which means it was scheduled months in advance, right? It wasn't him waking up, seeing the stock price, and panicking.
Correct. It's a preset diversification plan. But still, optics matter. When the guy running this sales engine is selling after a 150% rally, it's worth noting. It signals that even the insiders know the stock has had an incredible run and it's prudent to diversify. It doesn't mean the company is in trouble, but it shows that the valuation is fully recognized by the people inside.
Let's talk about the external threats. You mentioned the moat earlier, but surely the big dogs, the hyperscalers, aren't just going to let Palantir take the enterprise AI market without a fight.
That is the biggest structural risk. You have Amazon, AWS, Microsoft Azure, Google Cloud. They own the infrastructure. They own the plumbing of the internet. They're all trying to build their own AI layers on top of that cloud dominance. Then you have the data warehouse players like Snowflake or other AI pure plays like C3.ai. They are all gunning for the same budget.
But is it a zero-sum game? Can Palantir exist on top of AWS?
They can, and they do. But the risk is that Microsoft says, hey, we can give you 80% of what Palantir does, but it's free because you already pay for Azure. That commoditization is the long-term threat.
And there's a macro risk here too, right? Palantir feels like a stock that loves low interest rates.
Exactly. Palantir is what we call a long-duration asset. Its value is based on massive profits expected years in the future. When interest rates are high, that future money is worth less today. If interest rates rise, or if the market rotates out of tech and into safer sectors like utilities or staples, Palantir often falls harder than the broader market because it has that high premium built in. It's a high beta stock. It moves fast in both directions.
So we have a clear bull case. Incredible commercial growth, rule-breaking efficiency, and a sticky product. And a clear bear case, sky-high valuation that demands perfection and looming competition. For everyone listening who is trying to figure out what to do next, let's talk about what to watch. What are the triggers coming up in the next 30 days?
The immediate catalyst is right around the corner. February 2nd, 2026. That's when Q4 earnings drop.
And the street is expecting big numbers.
But the consensus is roughly $1.33 billion in revenue. But honestly, for Palantir, the beat on revenue is almost expected now. The market yawns at a revenue beat. The real key, the thing that will move the stock 20% in either direction, is the guidance.
They raised guidance 3 times in 2025. They set a precedent.
They did, and the market is now addicted to that pattern. They need to see Palantir raise the bar again for full year 2026. If they come out with conservative guidance or even just meet expectations, the stock could sell off. The market wants to hear that the acceleration is continuing, not leveling off.
Okay. Beyond earnings, what about the macro picture? I know the defense budget is always a factor, even with the commercial pivot.
Keep a very close eye on Washington. There are talks of a $1.5 trillion U.S. defense budget. Any headlines regarding defense modernization or specific allocations for AI warfare directly fuel Palantir's government business. Remember, government revenue is still growing at over 50%. If that budget gets approved with heavy AI earmarks, that is rocket fuel for their Gotham platform.
And finally, product momentum. We keep hearing about these AIP boot camps. Should we just be watching the press releases?
Watch the industry conferences. When Palantir announces a new massive contract, like that recent Navy deal, it validates the product. But specifically, watch for commercial customer announcements. If they announce a partnership with a major retailer or a major manufacturer, it proves the operating system thesis is working beyond just the early adopters. We want to see boring companies adopting this, not just tech-forward ones.
Okay, let's wrap this up with the lowdown. We've looked at the numbers, the risks, the catalysts. Here is the final thought I want you to chew on.
Let's hear it.
Is Palantir becoming the first true compounder of the AI age? We are seeing proof that you can have hypergrowth and massive profits simultaneously. That's the holy grail. Or is this a dot-com style valuation bubble waiting for a pin? When you are paying 100 times sales, you are betting on a flawless future.
It's the classic risk-reward dilemma. If they execute, they become the most important software company of the decade, the Microsoft of the 21st century. If they stumble, the fall is steep.
Exactly. So check your own risk tolerance before you chase that vertical chart. Don't invest money you can't afford to see fluctuate.
Wise words. Stay safe.
That's it for this edition of the Easy Money Show. Thanks for listening, and we'll catch you on the next move.